Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. KYC over privacy. Binance lowers withdrawal limits for anonymous users in its quest for compliance. What you need to know and how this could affect you. No more getting wrecked with 100x. Cryptocurrency exchanges begin lowering their maximum leverage for futures trading. Why this is actually a good thing for the crypto market. CeFi meets DeFi. Robinhood and PayPal reveal they're looking into crypto lending, borrowing and staking, as the former IPOs and the latter expands to the UK. Which DeFi protocols could benefit? Uncle Sam is coming for your sats. US politicians are in the process of passing a bill that could cost crypto companies and even crypto holders billions. Here's why it's not all doom and gloom. Yet. Grabbing stablecoins by the groin. Another crypto bill proposed by US politicians wants the government to have total control over the issuance and distribution of dollar-backed stablecoins. Will they turn into CBDCs? German law brings Bitcoin to mar and par. As of today, institutions in Europe's largest economy can legally invest in cryptocurrency. Here's how much they could be putting in. And a closer look at Ethereum's upgrade and the continued recovery in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Last Tuesday, Binance announced that it will be lowering the daily cryptocurrency withdrawal limit for any users who have not completed KYC from 2 BTC down to just 0.06 BTC. As per their blog post, this change is effective immediately for any accounts made on or after July 27th and will be gradually phased in for older accounts starting August 4th. That's this Wednesday, by the way. Users who complete KYC will have a daily withdrawal limit of 100 BTC, which is likely more than enough for most people. Not everyone is on board with this decision, with many saying that the 0.06 BTC limit for unverified is too low, as it works out to roughly $2,500 US. The response was even more visible on the price charts and on-chain indicators. The crypto market took a dip as anonymous investors pulled out and BTC exchange balances took a nosedive. The Binance Smart Chain also reached a record for daily transactions in the days that followed, likely from investors pulling out of or even moving their crypto onto the BSC for more privacy. Though this policy change is probably not an issue for everyone, it is important to be aware that accounts which have not completed KYC will likely be subject to additional scrutiny going forward. It's even possible that KYC will become a requirement to withdraw any cryptocurrency at all, as is the case on many other regulated exchanges. As such, you have 3 options. 1. Accept the lower limit and hope that it won't be changed again when the crypto market starts to rally. 2. Complete KYC to save yourself the headache. Or 3. Familiarize yourself with decentralized alternatives to centralized exchanges and the services they provide. If you decide to go with the third option, I have a few videos that might help, and you can find those in the video description. Besides bringing in KYC, Binance is one of the cryptocurrency exchanges which recently announced that it would be reducing its maximum leverage from 100x to 20x. The other cryptocurrency exchange in question is the FTX derivatives exchange, which lowered its upper limit on leverage from 101x down to 20x shortly before Binance did the same. For those unfamiliar, leverage trading allows you to get more exposure to an asset with less underlying capital. As a simple example, if you have $100 of BTC and you trade with 10x leverage, it lets you trade as if you had $1,000 of BTC. This means that if BTC goes up by $10, you're up by $100. Now, this sounds amazing on paper, but in practice it's extremely risky, because if the price of BTC drops by just $10, that $100 of BTC you put up as collateral will be liquidated, aka sold. Now, in case you didn't do the maths, trading $100 of BTC with 100x leverage means that a $1 change to the downside is enough for the exchange to sell your BTC. Now, because BTC is volatile and can change by thousands of dollars per minute, this has caused billions of dollars of losses across the board during turbulent times. Not only that, but the large amount of leverage a lot of crypto traders are using has the potential to create a chain reaction, where BTC liquidations crash the price of BTC so much that it triggers even more liquidations. You can actually see this on Bitcoin's price chart during dips. Those massive wicks at the bottom of those red candles are leverage traders being liquidated. Put simply, high leverage makes crypto market dips that much worse. Restrictions on leverage trading are a good thing for the crypto market because it will reduce volatility during downturns, at least in theory. Moreover, it's highly unlikely that professional traders and institutions are the ones trading with higher than 20x leverage. Those that are getting wrecked on 100x leverage generally tend to be inexperienced retail traders who don't understand the instruments. So, all in all, a massive win for the crypto space. While cryptocurrency exchanges limit their features, centralized fintech giants are expanding their crypto product offerings. Robinhood was the first to break the ice with an announcement that it will be adding crypto lending, borrowing, and staking services to its platform just 2 days before listing on the Nasdaq. Although Robinhood stock didn't perform too well in its first few days of listing, the addition of these services, as well as support for cryptocurrency withdrawals and deposits, will likely add to its valuation. This is because PayPal has seen exactly this effect as a consequence of rolling out its own crypto services last year. PayPal's Q1 earnings this year saw a whopping 1,200% increase in net profit because of its crypto offering, and it looks like it's just getting started. PayPal has apparently finished its secretive, quote, crypto super app, which will likewise feature crypto lending and borrowing in addition to an AI-driven high-yield crypto savings account. As a cherry on top, PayPal will begin offering its crypto products to users here in the United Kingdom. Now, this is significant because the UK is another place that has seen a lot of crypto adoption of late. In terms of which crypto projects are likely to get some cream as a result of these DeFi dreams, the top contenders are Uniswap and Aave. As I mentioned in last week's crypto review, a deleted presentation by Uniswap's growth lead at the Ethereum Community Conference revealed that they are in talks to integrate with both PayPal and Robinhood. The problem there is that legacy players want Uniswap Labs to enforce KYC on all its users, something which it likely cannot do even if it wanted to. By contrast, Aave has already been working towards permissioned lending and borrowing pools and has even rolled out a few for select institutions. It will be interesting to see how this dynamic plays out over the coming months, and later this week I'll be doing an in-depth video about the incoming cryptocurrency regulations that could cause crypto-wide KYC, so stay tuned for that. Speaking of regulations, politicians in the United States slipped in a concerning addition to their upcoming bill that could be really bad for crypto. Basically, the US government wants to spend $550 billion to build up the country's suboptimal infrastructure, and they want $28 billion of those dollars to come from the crypto industry. Naturally, the way they're going to get this money is by taxing the shit out of what the bill calls, quote, brokers who deal in cryptocurrencies. The problem is that this definition is so broad that it could apply to everything from crypto miners to crypto wallet providers to DEXs and possibly even to individuals. Now, the reason why this is a big deal is because filing taxes requires KYC documentation, which means that every individual or institution that's considered a broker would have to collect and complete KYC information. Now, before you panic, consider the following. It is possible, if not likely, that this bill will not be passed until mid-September. This is because US politicians are taking their 6-week recess, which will last until that time. And here I was thinking recess was just for children. Anyways, Congress passed the bill to the Senate just before they started their recess last week, and the Senate's recess will begin at the end of this week. The finalized text of the bill should be coming out in the next few days, at which point the Senate will make amendments here and there. Given the fact that powerful crypto advocacy groups and lobbyists such as the Blockchain Association have already banded together to throw their weight behind changing the wording, with some luck this will become one of the amendments. Now, knowing politicians, I find it unlikely that the bill will be passed in its current form this week, but even if it is, the provisions it prescribes would not go into force until 2023. This gives a lot of time for crypto lawyers and lobbyists to get their ducks in a row and modify that section before it's put into practice, and gives us crypto holders a lot of time to prepare accordingly. Now, unfortunately, this isn't the only crypto bill we have to keep an eye out for, and this next one has much farther-reaching implications than KYC and taxation. Just before the United States Congress closed for the season, one of its constituents had the brilliant idea of tabling the most terrible bill for crypto that could possibly be concocted. Titled, quote, "The Digital Asset Market Structure and Investor Protection Act of 2021, the bill seeks to give the US Department of the Treasury total control over stablecoins, among many other things. One of these other things involves designating the Federal Reserve as the only institution which is allowed to issue dollar-backed digital currencies, paving the way for a central bank digital currency, or CBDC. In fact, the prospect of a Fed-issued digital dollar is more likely than you think. Now, if you want to know the full MO, then I suggest you watch my most recent video on what the Fed thinks of crypto, and that's linked to in the top right. Now, obviously, this bill would be pretty disastrous for the crypto market, but thankfully it looks like it won't be passing anytime soon because all the suits are out for recess. Something tells me that the crypto market will continue to rally in the meantime, and all the bullish news coming out definitely supports this suspicion. Starting today, pension funds and insurance funds in Germany can convert up to 20% of their assets into cryptocurrency. For context, Germany's so-called Spezialfonds collectively custody over $2 trillion in assets, which means that over $415 billion of that could potentially move into cryptocurrency. Germany is relatively friendly to cryptocurrencies, given that there are dozens of cryptocurrency ETPs available to investors, and crypto gains on any coins or tokens held for more than a year are non-taxable. To clarify, I'm not an accredited accountant or tax specialist either, so be sure to fact-check me on that one if you live or plan on living in Germany. That said, you can check out my video about cryptocurrency tax tips if you're looking for ways to keep more of your gains. You already know where to find it, bitte oben rechts. Turning to the market, we can see that we're green across the board, and this is all thanks to Bitcoin's epic recovery out of the dip from 2 weeks ago. What's even better is that Bitcoin dominance has been rising alongside BTC, which suggests that institutional money is on the move, and this can easily be confirmed with on-chain analysis. I suspect the supply squeeze caused by Binance's KYC clampdown has also added to the upward move. Note that the amount of BTC on exchanges is about the same as what it was when BTC was trading at 55k, which suggests we're going to see a lot of green in the week ahead. As you can see, we seem to be struggling around the 42k range, which is a historic zone of resistance. Many traders believe that pushing past this price point means we're headed back for new all-time highs. Now, personally, the price point I'm looking for is up around 45k, which would bring us above the 200-day moving average. With some luck, we'll see that 50-day MA cross the 200 MA, which would create a nice golden cross. In the event that we do drop down, the price zones I'll be watching are the 40k, 37k, and 35k range. When it comes to Ethereum, I think this is going to be a big week for ETH. The London upgrade is scheduled for this Wednesday, and it will finally introduce the long-awaited EIP1559 upgrade to Ethereum. As a quick recap, EIP1559 will see a portion of Ethereum gas fees burned, with the rest going to miners. What this means is that Ethereum could become a deflationary asset with enough network activity, and many believe that this is a given. Now, before you FOMO into ETH, keep in mind that it's possible that this upgrade has already been priced in. Alternatively, we could pump before but not after, or after and not before, or vice versa. Personally, I think we're going to pump throughout, but you all know that I'm an Ethereum bull. This week's winners are Thorchain, Quant Network, again, Seacoin, Anchor, and Neo, an interesting combination to say the least. Thorchain's Rune seems to be rallying because the native Thorchain blockchain has not produced a block in 11 days. This is because Thorchain's cross-chain DEX protocol suffered 2 severe exploits recently, and the developers are working to make sure no further exploits happen in the future. If you're wondering why Thorchain's blockchain being down is somehow bullish for Rune, the answer is supply and demand. A substantial percentage of Rune's supply exists on the Thorchain blockchain, with the remainder existing as a BEP2 token on the Binance chain. Because so much of Rune's supply can't be sold, the speculative price continues uninterrupted on Binance and elsewhere. In terms of when the Thorchain blockchain will be back online, it looks like it's going to be another couple of weeks. Even so, I am a strong believer in Thorchain and actually hold Rune as part of my portfolio as well. Now you can learn more about Thorchain by watching my video about it, which you can find in the description. Next, we have Quant Network, which continues to pump because of a recent Binance listing. I still find it fascinating that a cryptocurrency can just continue to go up and up, but I know for a fact that what comes up must come down. There's no such thing as up only, but for now, it is up only for QNT. I'm getting a similar vibe from Stablecoin, which is rising for reasons unknown. I could not find any cause for this effect, but it's not too important given that Stablecoin is still far away from its most recent high, much less its previous all-time high. If Stablecoin can break that 20-cent barrier, we could see a clean move to 24 cents, but in my opinion, that is unlikely to happen anytime soon, as all the attention is on Bitcoin for the time being. Anchor, on the other hand, is a crypto that could continue to go green for the foreseeable future. This is because Anchor provides a series of seriously sick staking services, such as Liquid Ethereum 2.0 staking, which tokenizes your staked 2.0 ETH as an ERC20 so you can still trade it, even though it's locked. Anchor has recently been expanding into other ecosystems, including Polygon and Polkadot, where it will support liquid staking for parachain slot auctions. Anchor also listed on Binance US last week. In terms of TA, Anchor seems to be struggling at the 10-cent range, but could muster enough strength to push up to the 11 to 12 range if the market permits. Lastly, we have Neo, which is reaching for the sky in anticipation of the mainnet launch of Neo's R3 blockchain. As far as I understand, R3 is just an improved version of Neo's current blockchain. What's interesting is that the blockchains are not backwards compatible, and holders of the current Neo will have to migrate their tokens over to the new Neo blockchain. I suspect that Neo is trying to leverage the same regulatory loophole that AMP did to land listings on US exchanges. If I'm correct, this means Neo could still have a lot of upside left, but it will probably take some time for enough bullish news to come through to break that barrier in the $50 range. Neo happens to be one of the cryptocurrencies that had the highest return on investment from ICO. And if you want to know what the other cryptocurrencies are, you can find out by using the link in the top right. And that, folks, is all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie or both. Links to all these resources are in the description. Thank you so much for watching, and I'll see you all in next week's episode.